Welcome back to our second presentation on stocks. And in this presentation, we will discuss the mechanisms for trading stocks, for allowing transactions, the securities marketplaces, as they are called. Some indices, some measures of the stock market, how we determine how well we're doing. And then we'll take a look at specific measures for individual stocks. And we'll start the process of what is sometimes called stock analysis, securities analysis. And I hope that you will find that it's really not as hard as people make it out to be. There's a whole world of people who want you to believe that you'll never understand how stocks work and how to value them and how to make prudent, long-term oriented decisions in the investment world, and they're absolutely wrong. But you got to pierce the veil, and that's what we're going to start to do today. Slide number 19. What is a securities marketplace? With the silly name, securities. Well, that's the fancy word for a financial investment. In fact, the BUS121 class we now call Introduction to Investments. We used to call it investments and securities. And people would say, I'm not an administration of justice major. No, not that type of security. A security is a tradable instrument that represents either ownership, a stock, or represents a loan, that's a bond. And then there's a few other versions of securities, but they're financial investments. And there's places where these things are bought and sold throughout the day. The granddaddy of them all was the New York Stock Exchange, the big board it was called. And this is a centralized location on Wall Street where brokers would get together and scream and holler at one another and buy and sell these stocks. Well, guess what, folks? There's very little of face-to-face interaction anymore. They're a tiny little bit. Virtually everything is done by computers. So you don't have to be sitting on the floor of the stock exchange to trade shares. You can be anywhere around the world, and people are. So much so that the New York Stock Exchange has become sort of not that important. In fact, it was bought by a company in Atlanta that didn't even exist until the year 2000. Just recently, a few years ago, it was bought by Atlanta. Forget the name. Intercontinental something or other. Yeah. Bizarre. And then the American Exchange was right down the street from the New York Stock Exchange. In fact, it started outside the New York Stock Exchange on the curb. And that's why people called it the curb. But now it's owned by the New York Stock Exchange, and the New York Stock Exchange changed its name from American Stock Exchange to New York Stock Exchange MKT. MKT, or I guess that's market, I don't know. Why? Oh, who knows why? Because the American Exchange was always really, really small compared to the New York Stock Exchange. But the new kid on the block is the NASDAQ. The National Association of Securities Dealers Automated Quotation System. Well, they don't want you to remember that acronym. All they want you to know them as is the NASDAQ. And it's all uppercase. Figure that one out. And the NASDAQ was a place that started in the 70s, all electronic. There's no centralized location. There's no place where people are screaming and hollering at one another. It was all computerized. And interestingly enough, many of the computer companies that started up in the 70s and the 80s, like Apple and Microsoft and Oracle and Dell, they decided they would start on the NASDAQ. And the idea was once they got large enough, they would move over to the New York Stock Exchange. Once they got large enough, they said, you know what, we're happy on the NASDAQ. We're going to stay on the NASDAQ. And you could hear two words in the 19th floor of the Wall Street New York Stock Exchange. The first one was O. The second one was now there's a race. And these companies are trying to get bigger and bigger and bigger and swallow up smaller companies, smaller trading places around the world. It's a urge to merge. And then there's the over-the-counter markets. Did we talk about the penny stocks, folks? Yeah, well, this is where those are traded. The New York Stock Exchange, the NASDAQ, they want nothing to do with these companies, folks. But the bulletin board and the pink sheets, now I think they call the pink sheets the over-the-counter markets. Over-the-counter market or something like that. These are places where the riffraff live. The wrong side of the tracks, the red light district. Stay away from the companies on the bulletin board and the pink sheets. And so let's read together. For hundreds of years, marketplaces were, and still are for the New York Stock Exchange and the NYSE, it's the same building, centralized locations. But with today's technology, the vast majority of transactions now occur electronically. The centralized locations are still in operations, but very few transactions occur there anymore. As far as I'm concerned, the only reason they keep it open is so that they have something for television. That's my, I don't know, maybe I'm wrong, but it looks like that's all it's open for, because you see them, they're standing around and not doing anything. There's a couple people trying to make deals, but for the most part, they're just standing there looking pretty. Slide 20. How do we know how we're doing? Well, we use what are called indices, stock market indices. To gauge the current condition of stocks in general, financial professionals have created various stock market indices. It's just a list of companies. It's a list, that's all it is, a list of stocks. And the one that you hear the most about is the Dow Jones Industrial Average. The Dow went up, the Dow went down. What the hell does that mean? Well, all it is a list of the 30 largest and best known companies. That's all it is, folks. There's nothing spectacular about it. And it's been around since 1896. I think that's why it's the most popular, because it's the one that's been around the longest. Who is Dow, by the way, Dow Jones? It's the company that publishes the Wall Street Journal, and it used to be privately held for over 100 some odd years, and now it's owned by Fox News. In fact, my understanding is Rupert Murdoch, who runs the empire, he didn't really care about the Dow. All he wanted was the Wall Street Journal. He wanted to own the Wall Street Journal. So now the Dow is no longer, I think, I'm not sure I quite understand, but I think it's being managed by somebody else. I think it's actually being managed by the next company, and that is Standard & Poor's. You ever heard of Standard & Poor's? They've been around a long time, and it's the same company. It's McGraw-Hill owns them. Same company that made your textbook. They make a lot of textbooks. They make a lot of money off of textbooks. And they own radio stations and television stations, and they also own, McGraw-Hill owns Standard & Poor's. So Standard & Poor's, we saw them in the previous chapter when they are one of the companies that rates bonds. Well, they also have the very famous index called the Standard & Poor's 500, and we'll see that in the next chapter. That it traditionally is the 500 largest companies in the United States. The blue chip companies, the income, some of them are cyclical, but the big companies, large companies are in the Standard & Poor's 500. And this one is actually more important, in my humble opinion, than the Dow, because the Dow's only 30 companies. By the way, before I continue, right now in the face-to-face class, we would do an instrument together, the stock investing over the 82 years ago. So it's on the website. I want you to do it. Look at the left side. Don't peek. Don't look at the don't peek part. Look at the first one, and then listen to the commentary, and then decide which one, which stock you want, and then peek, and you'll see how well you've done for the 30 companies. But the Standard & Poor's is a much more important one, in my humble opinion, much more useful, and we'll come back to it in Chapter 13 because many mutual funds use the Standard & Poor's 500. What's the NASDAQ? Well, the NASDAQ is that place where the high-tech companies are, right? So the NASDAQ has their own index that is mostly comprised of high-tech companies. Not all. Costco and Starbucks, they're on the NASDAQ. So are they really tech companies? I don't think so, but still. So most of them are that's where Apple and Microsoft and Intel and Oracle was there, but then they moved to the New York Stock Exchange. Facebook, Twitter is actually on the New York Stock Exchange, but mostly it's comprised of high-tech companies. So you hear on the news, the Dow went up and the Nasdaq went down. What are they saying? Well, the big companies, or the S&P, Standard & Poor's 500 went up, and the Dow went, and the Nasdaq went down. Well, the big companies, the old guard, they went up, but the new technology companies, they went down. That's what they're talking about. And they're just looking at a list of companies and averaging the price. Those are the three biggies. You may see some others, and we'll quickly go over these. The Dow Jones U.S. Total Stock Market Index, which I think is a very stupid name. It used to be called the Wilshire 5000. It was approximately 5,000 stocks. Actually, it's more, but it changes. And this is meant to take a look at the large companies, which is the Standard & Poor's 500, plus the medium-sized companies, plus the small companies. It was designed to gauge the entire stock market. And it sounds like, wait a minute, there's 5,000 stocks, but only 500 in the S&P 500. But those 500 in the S&P 500 make up 80% of the total market value. So 500 companies make up 80%. The other 4,500 make up about, 19. And then there's a bunch of companies that make up 1%. A lot of companies are worth, nothing compared to the big companies. So the idea was, let's see how the entire market's doing. But realize that the Standard & Poor's 500 is much. It wags the tail of the dog. It's the important part, where the other guys are the tail. They're not that important. And how do we take a look at just small and medium-sized companies? You may every once in a while hear about the Russell 2000. You don't hear about it too much because, as we said, they don't really represent that much of the value of stocks in the United States. I mean, they're important companies, don't get me wrong. Small companies, every large company was originally a small company, but by definition, but these don't really amount to as much of the action, if you will, in the stock market. Although there are some people who say this is where you should be because these companies have the potential to become very, very large, and they're absolutely true, folks. But they also have the potential to fall into the porcelain oasis, because when the organic matter hits the ventilating device, I've used these phrases over again, haven't I? When things go bad, the small companies get destroyed. The large companies have the roots deep in the economy. They can withstand the storms. These companies get blown away. Now, how do we look at outside the world? It's becoming more and more important. Well, about late 1960s, early 70s, a mutual fund company, actually, believe it or not, but they don't own it anymore. They started the World Index, and that's why it's called Morgan Stanley Capital International. Capital International was part of the mutual fund company. It's actually called the American Fund, but that's not what they call themselves. And then they sold it to Morgan Stanley because they didn't want to have a conflict of interest. They're measuring the gauge that they use to gauge themselves, so they sold it off. And for many years, there were two of them. The World Index, which was the global stock market. That included everybody, including the United States. And then the EFA, and that's how it's pronounced, Europe, Australia, and the Far East. And that was everybody except for the United States. Well, now they've changed the names and changed the characterizations, which I understand, but I wish they would have come up with a better name. The problem with the World Index and the EFA Index is that they just looked at the developed world, as it's called now. We used to call it the First World, which wasn't a very nice name. Well, not nice to call the Third World. The Third World, there's only one world, folks. But that was the United States, Canada, Western Europe, Japan, Hong Kong, Australia, Singapore. So developed markets with mature industries and mature stock markets. And so, but now, the developing world, as it's called, it used to be called the Third World. The developing world has gotten big, and it's part of the world. So now we call the index that looks at everybody the Morgan Stanley Capital International All Country World Index. Dumb. And the one that is everybody but the United States is the Morgan Stanley Morgan Stanley Capital Index I'm sorry, Capital International. Oh, don't worry about it. I'm getting confused. Don't worry about MSCI. Don't even worry about that. All Country World Index ex-USA. Ex-USA means outside the United States. So what that does for us, it allows us to look at the entire world as an entity, and then allows us to see how markets are doing outside the United States. And we'll come back to these in Chapter 13 when we discuss mutual funds. So, do you have to memorize these? No, don't. Just write them down so you can at least you could identify them. You don't have to remember them from memory, but so you can identify them and say, oh yeah, Russell 2000, small companies. Dow Jones U.S. Total Stock Market Index, Wilshire 5000, everybody in the United States. World Index, everybody in the world. World Index ex-USA, everybody except for the United States. Okay, I know, I get excited about them. Slide number 22. Have you heard the terms bull market, bear market? I sure hope so. A bull market, investors are optimistic, more investors are buying stocks, the stock market increases, standard of living is going up, people are getting raises. Why do they call it a bull market? Because bulls charge ahead and they throw their opponents up in the air. Right? Bear markets, everybody's sad, investors are pessimistic, more investors are selling stocks. Now, a bear market is officially when it goes down 20% or more, versus a market correction, which is 5, 10, 15%. What's the difference? Well, 20% is a pretty big jump down, but it happens a lot more than people think it does. Historically, it's happened every 4 or 5 years or so. Hasn't happened since 2008, folks. Got close, got down to 12, 15% a couple of times, but no, it has not gotten to 20% since the Great Recession. And so we know it's going to happen. I don't know when it's going to happen, but we know it's going to happen. But people say, you think it's going to be a crash? I say, yeah. They say, oh, what should we do? What should we do? No, nothing. I mean, I don't know when it's going to happen. I knew it was going to happen. It wouldn't be the future, and I could make a ton of money if you could go back in time, but you can't do that, and that's not the way the world works. Oh, by the way, why is it called the bear market? Well, everybody will tell you it's because bears they're more reclusive and they tend to knock down their opponents with their claws. But that's not the real reason, but you can use that reason. The real reason's even weirder, so we won't go into that. Slide 23. All right. It's time to do our stock analysis. Where do you start? Well, let's start with some of the most popular measures of stocks. And as Benjamin Graham, the author of The Intelligent Investor, Warren Buffett's teacher, by the way, said, show me the numbers, right? Right out of a movie. And some of the more popular over the years have been these that we're going to go through over the next few slides. Capitalization, book value, earnings per share, price to earnings ratio, dividend yield, current yield. They are the most popular and, certainly a great place to start, but it's just the beginning. But as I said, and I'm going to say it again before we leave, I hope to show you that this stuff is not as hard as people make it out to be, and that you too can look at a company, look at their statistics, and say, yeah, I see this, and that. I see that. This could happen, that could happen, so that you have your eyes wide open before you invest. Now, I certainly hope that if you do decide that you want to buy individual stocks, you would take a course such as BUS121, Introduction to Investments, or, educate yourself or take a class at some other college. It's not going to be good as ours, of course, but I'm not biased or anything. But definitely, because it's tricky, and you really need to have your eyes open and not just follow the crowd, because we see what happens when you follow the crowd. Right. Okay. So let's get started, huh? Okay, slide number 24. Capitalization. Huh? Capitalization is a fancy word for how much is the company worth. You see, people concentrate on the stock price, but you don't know what the company is worth unless you know how many shares there are. So it's a very simple formula. The number of shares out there, outstanding, it's called number of shares that are out in the world, multiplied times the current price of the stock. And that's what the company is worth according to investors, because the investors are buying and selling the shares at that price, and they're saying this is what we think the company is worth. And we'll take a look at the example, and there's a worksheet that you're going to work through on your own, and don't worry, there's an answer key, and we do it in the face-to-face class together, and there's a commentary. So there are three major categories: Papa Bear, Mama Bear, and Baby Bear. Large cap, mid cap, small cap. There are a few subcategories that you can take a look at, but these are the ones I want you to remember. And a large cap company is anything above 10 billion or so of market worth. Exactly. So remember that. 10 billion or higher, large cap. Now there's a subcategory of the large cap called mega cap. These are companies that are worth hundreds of billions of dollars. Google, Apple, Walmart, Exxon, GE. Exactly. And but you don't have to remember that. As long as you remember large cap, that's good enough. Mid cap are company, and by the way, most of these large caps, you've heard these companies. They're name brand, household names. Some of them aren't, but most of them are. Mid cap stocks. These are companies, some of which you've heard of, a lot of them you haven't. Anywhere from $1 or $2 billion. Now it depends on who you talk to. $2 billion for some people is where it starts. $1 billion is where it starts for others. Upwards of $10 billion. They're the mama bears. And then the baby bears are the small cap stocks. Anything less than $1 or $2 billion. Why do we say 1 or 2? Because some people think 1 billion is where it stops, and other people think it's 2. But small company stocks, most of which you've never heard of these companies, some of which you have, but maybe because they're local. Once you get below about 100 million, then you're in what's called the micro cap world. It's a subcategory of small cap. So I don't remember again. I don't care if you don't remember that. You don't have to remember that. What you have to do is remember large cap, mid cap, and small cap. And then there are the penny stocks. Thousands of them with, just outrageously small market capitalizations because they're really not worth anything. They're just a shell, a sham. So we shouldn't even mention those in polite company. So here's an example. If I have a company whose price is $50, what's the company worth? Well, I don't know. Right? I have to know how many shares there are. So I look up how many shares there are. There happen to be 2 million shares. And I multiply 50 times 2 million and 2 million, and I get $100 million of market capitalization. So is this a mama bear, papa bear, baby bear? It's a baby bear. It's a small cap stock. The stock price, dear students, for the most part is irrelevant until you get into the penny, and then it's very important. It means it's a scam. You must look at the market capitalization to see what the company is worth. And we'll take a look at some real-life examples in a bit. Slide number 26, the book value. Do you remember net worth statements? Assets minus liabilities? Well, the net worth is determined by deducting all the liabilities from the corporation's assets and dividing the remainder by the number of shares outstanding. What does that mean? In other words, if you were to liquidate the company, sell all the assets, pay off all the debts, how much would be left? And it's rarely close to the stock price. It's often 1/5 or 1/6. Sometimes it's close to the stock price, but not usually. Why? Well, think about it, folks. A successful business is worth much more intact than if it were liquidated. Look at a pizza shop. I mean, what's the pizza shop worth? It's worth far more than the pots and the pans and the tables in the kitchen. I mean, yeah, the fact that it's making money means that it's worth a lot more than the assets on the books. Now, here's what happens. If a stock is whatever, for whatever reason, the technology is beating it up or whatever, or their competitors are beating it up. if the stock price goes lower than the book value, there is a danger of the company being raided for the assets and put out of business. They're called corporate raiders, takeover artists, private equity firms. What they do is they see a company that's, for whatever reason, still has plenty of assets on the book, but the stock price is going lower and lower and lower because investors are not happy with what's going on with the business. They will whoosh in, buy up the shares, sell all the assets, pay off the debts, and walk away with money in their pockets. And oh, by the way, they lay off all the employees. Now, how would you feel if that were your company, someplace you worked at for 22 years? You'd be pretty darn pissed, right? You'd be very angry. Because what are these and some of them, one of them ran for president in 2012. That was Mitt Romney. He worked for Bain. Don't you like the word Bain? Bain Capital. And that's what they would do. That's their job. And people will complain to their politicians, and politicians want to get elected, and they'll make noises like, we have to do better for our employees, and they'll say all these great things, but really they know, because the economists tell them, that you don't understand. This is capitalism at work. This is how it should work. The capital, meaning the assets, the money, the resources, that was locked in that company was not being efficiently used. It needed to be plowed under, like a field of corn that needs to be plowed under for the next crop. And so that's scant condolence to the people who lose their jobs. But this is why we have unemployment insurance. We don't have unemployment insurance to pay people not to work, folks. We want them to go find a new job. And here, in the meantime, here's some money to help you through to find a new job, because that company needed to be plowed under. Does that make sense? I hope so. It doesn't make it any easier for the people who lose their job, but it makes for a more efficient economy, and that makes for a better standard of living for everybody. And it sounds like I'm running for office, which I'm not. I'm not running for office. I just believe that we have to make this system the best it can be, because, as we said, it's the worst possible system, except for all the others. Slide 27. Now, here are two statistics that are very important. Earnings per share and price to earnings ratio. The earnings per share lets you look at your stock, your one share of stock, as if it were a little business. What is my stock making for me? How much money is it making? Because what you do is you take the after-tax earnings and divide it by the number of shares. And what investors often do is they look for growing earnings. Remember the growth stocks? The price to earnings ratio then relates that those earnings, back to the price of the stock. And a lower price to earnings ratio means the stock is less risky. A higher price to earnings ratio means the stock is more risky. But at the same time, it also tells you that investors are more excited about the opportunities for that stock with the higher price to earnings ratio. We're going to see some examples in a bit if it doesn't make any sense. But think about it, folks. Why do you want to own a business? To make money. So isn't it good to know how much your share of stock is making and how much you had to pay to earn that? Yeah, and that's what these two statistics tell us. So let's take a look at some examples. The company earned $2.5 million. Well, to you and me, that's a lot of money, right? But to a company, that might be pittance, right? They blow that on a Super Bowl ad. But we don't know the earnings per share until we know how many earnings are out there. So in this case, the company had 5 million shares outstanding, we say. 5 million shares out in the world being traded amongst investors. So you take the 2.5 million and divide by 5 million. I know some of you, my calculator doesn't have that. Just cross off all the zeros, right? Cancel the zeros, as it's called. I hate that word, cancel. And you can wind up with 50 cents. And that means every share that you own has earned 50 cents. Like a little factory, a little business that earns every share earns 50 cents. Cool? And what you as an investor are often looking for are companies that are growing their earnings. Now, some are growing their earnings very quickly. They're the growth stocks, and some of them are doing it slowly but steadily. I like the slow and steady, folks. But everyone's different. That's why there's chocolate and vanilla, and some people like strawberry. And you can always have all three. Slide number 29. Now, let's relate those earnings for that stock back to the price. Let's say that company that was earning 50 cents a share has a stock price of $10. Then we take price divided by earnings, PE, that's what it's often called, and it's written often as P/E or just PE. You take $10, the price, divided by 50 cents the earnings, and you get 20. Now, don't put a dollar sign, don't put a percent sign. It's unitless. So 20. What does that mean? I don't know. Well, let's take a look. It actually does mean something. Slide number 30. Historically, a PE ratio of 20 or above was considered high and reserved only for the fastest growing stocks, the growth stocks. 5 to 15 was considered average. Well, right now, 15 is about average. And for almost 30 years, a PE ratio of 40 or 50 was not uncommon amongst growth stocks like Starbucks and Google. It's actually a lot higher for Google for a while there. And then I will never forget this, folks. I looked down at the computer screen in 1998, late 98, or not 99, I think it was. And I just saw eBay's PE at 10,000. And I said to myself, this isn't going to continue. I don't know when it's going to fall, but it's going to fall hard. And I was right, but you just didn't know when. I didn't think it was going to happen in year 2000. I thought I was going to wait a couple of years, but no, boom, it really hit in 2001 and 2, but it started falling in 2000 and then 2001 and then 2002. Yeah. So we're looking for an average about 15 or so. That's average, 12 to 18. 25, 30, that's high. And then you see some companies with really high PEs. And you see some companies with really low PEs. Now that can be dangerous too, because that usually means that investors are running away from that company. That was GE in 2006 at a very low PE because it was still earning money, but its price kept falling and falling and falling because investors were getting hip. You better get out of GE fast, and they were right. It had a low PE because people thought it was going to fail, and it turned out they were right. So slide number 31. Dividend yield. The dividend yield harkens back to our discussion about dividends when we are paid for owning the stock, the distributions of the earnings. And this allows us to compare a stock to a savings account or a bond because you take the dollar amount of dividends and divide it by the stock price. And as we said, dividends were in the 4, 5, 6% range for decades and decades because stocks were considered so risky. But then in the 1980s and 1990s, they went down to 1%. That was right before the bear market of 2000 to 2002. Many companies are paying 2, 3%. Some are paying 0. They pay no dividend. They're returning the money, putting it back in the company. And others are paying 4 and 5% or more. So you really have to sniff around. And here's an example here. This company is paying $1.40. $1.40 in dividends. The market price is $87.50. Well, if we take the $1.40 and divide it by $87.50, we wind up with 0.016 or 1.6%. And you can write it either way, folks. But we like to see at least 3 or 4. Well, this one works out evenly to 1.6%. But we like to see 3 digits or so, 4 digits. So is that high? No, it's on the low side, but still, it's better than what a savings account is paying at a bank or a credit union, isn't it? Yeah, it is. But what's the difference? Right. The bank or the savings account, that money is guaranteed. Is the 87.50 guaranteed? No. Tomorrow it could fall to $50 or go up to 100, or in the case of a company going bankrupt, it can become worthless. Stocks are risky. So now let's take a look at some real life examples. Let's take a look at some real life companies. You ever hear of Walmart or Costco? Little mom and pop shops that sell little trinkets and everything under the sun. Anyway, okay. Now you look at the price. This is July 8th, 2016. You look at the price and you say, wait a minute. Costco is bigger than Walmart? No. You know that it's not, right? Well, Walmart's much bigger. Walmart's all around the world. Now Costco is getting around the world. They're on their heels. And we look at the earnings per share and we find that Walmart earned $4.52. Costco earned $5.22. And we relate the earnings to the price divided by earnings, PE, and we find that Walmart is 16, which is about average, but Costco is over 30, 31.7. Now, what is that telling us? What that's telling us is that investors are, they feel that Walmart will continue to do fairly well. Okay, average. But what are they saying about Costco? They're saying that they believe that Costco's future is far more bright, far more exciting than Walmart's future. Now, you have to decide why that is and whether or not they're right. See, it's simple to make that evaluation and say, yes, investors are more excited about the prospects for Costco than they are for Walmart. But are they right? And that's why, as Warren Buffett says, investing is simple, but it ain't easy. Because we won't know for another 3 to 5 years. We won't know if Costco can deliver and grow faster than Walmart. I think they will, but doesn't mean I'm right. And you might think they won't, and that doesn't mean you're right. It doesn't mean you're wrong. That's what investing is all about. You'll hear people say you pays your money and you takes your chances. Well, I think it's better than a 50-50 chance that both of these companies are going to continue to do well. But if Costco doesn't deliver, right, you understand, the PE is going to fall dramatically, which means the price is going to fall. That's the danger, right? Danger, opportunity, that's why stock investing is risky. Look at the book value. If you were to sell all of the assets of Walmart, pay off all the debts, you'd have $24 left. Well, the stock is worth $74. You wouldn't do that. And the same thing is true, even more so with Costco. And as we said, a business is in business to make money, and it's worth far more intact, assuming it's a good company and it's still prospering. It's worth far more intact than if you were to destroy it, liquidate it. The dividends per share are $2 for Walmart, $1.80 for Costco. So dividing that by the price, we see that Walmart's paying us 3%, which is pretty darn good. That's actually a little bit above average now. And Costco's only paying us 1.2%. Right, and that tells us yet again that investors are more interested in the growth prospects for Costco than they are for Walmart, because Costco is not paying as much on a percentage basis. Here's the market capitalization. Remember we said, Walmart's a lot bigger than Costco? Yeah, well, it's over 3 times bigger than Costco. There are, I forget how many billion shares. I think about 6 billion shares of Walmart out there. So if you wanted to buy Walmart, you would need $230 billion. Nobody's going to buy Walmart, by the way, folks. And that's how much it's worth. $230 billion. That's the market capitalization. It's a mega cap stock, a large cap stock. Costco is worth $72.5 billion. And remember, this changes every day as the stock price goes up and down. still a large company, a very large company, but not a mega caps company. And so investors are thinking, you know what? Costco's got more room to grow than Walmart. And are they right? Well, we'll see in 5, 10 years. 3, 5, 10 years, yeah. They're both good companies, folks, in terms from an investor point of view. I don't like the way Walmart treats their employees or their customers. I like the way Costco treats their employees, and I like the way they treat me as a customer, but that's different. We're talking about investments here. Here's another couple of companies that you may have heard of. McDonald's and who is Yum Brands? Well, we've already mentioned them. You know them as Kentucky Fried Rat, Taco Bell, and Pizza Hut. There's a whole lot of money, folks, selling people bad food. Grease, fat, sugar, salt. People just love it, and it makes them a whole lot of money. But we said Yum Brands used to be part of PepsiCo, and they spun them off. Yeah, it's called Yum. That's the symbol, by the way. So McDonald's price is $121, and Yum is $86. So you think, well, Yum is, it's getting close to the value. No, Yum is nowhere near as big as McDonald's yet. But it's growing faster. At least that's what investors believe, as we'll see from the PE. Earnings per share, $5.20, $3 for Yum. PE for McDonald's is 23. PE for Yum is 28. So which one are investors more excited about? They're more excited about Yum. Not that much more excited, because they both have pretty high PEs, but more excited. Look at the book value of McDonald's and the book value of Yum. Don't break up Yum Brands and try to sell off all the assets and pay off all the debts. You won't make much money. But look at the dividends. Pretty darn healthy for McDonald's. $3.56, so 3%. $1.84 for Yum, 2.2%. 3% is pretty good. 2.2 is about average, a little bit lower than average, but that's about average for a company. And notice they're both large cap companies. McDonald's is just above the mega cap world. But Yum is about 1/3 the size of McDonald's. So that's why investors are a little bit more excited about Yum Brands, because they think they have more room to grow. And they were growing like crazy in China, folks. It's such an unbelievable business case study, which, if you're into that, you might want to take a look at that. They were selling, it turned out the Chinese, they like chicken more than they like beef. And so they were Kentucky Fried Chicken is really, really popular. And everybody would drive their Buick, because that's the luxury car in China, down to the Kentucky Fried Chicken. And then all of a sudden, they were empty. Why? The bird flu. Even though there's never been a case of a human contracting bird flu from a dead cooked chicken, the bird has to be alive for a human to catch the bird flu. People were so frightened that they emptied out of the Kentucky Fried Chickens in China. They're back, but still, it took a while to educate them. Indeed. Okay, our last couple of companies we'll take a look at are AT&T and Verizon. Now, again, you can like the investment and hate the stock, hate the company, love the investment, love the stock, and hate the company, but I don't like either of these companies, folks. I have just heard so many bad stories about the way they treat their customers, but supposedly it's getting better. But hey, these are darn good investments, as we'll see. You might think that Verizon is bigger than AT&T. Well, it is, but not much. No, actually, AT&T is a little bigger than Verizon. But we have to look at the market cap. Earnings per share, $2.36, $4.41. PEs are, average for AT&T. Actually on the low side for Verizon. Why would that be? Well, because pretty much everybody already has their cell phones, aren't they? Right, exactly. But they milk them, folks. Where do you see how much they milk those things? The book values, $20, $4.50 for Verizon. But look at the dividends per share. $1.92 for AT&T, $2.26 for Verizon, 4.5%. 4%. Look at those dividend yields. That's more than what AT&T and Verizon are paying for their bond payments, their bond interest payments. Those are rich dividends. And let me ask you a question. Do you think people are going to give up their mobile phones? I just was looking at Verizon and they're raising their prices. They must feel very, very confident that people are not going to give up their cell phones. They're raising their prices. So, here are two companies that personally I don't think are that great, but as investments, they're great for dividends. And look at this, capitalization, $262 billion, $228 billion. Both of these are mega cap companies, which makes sense because everybody is now addicted to their cell phones. Okay, so what do you think? Do you, as I have posited, do you agree with me that this is really not as hard as people make it out to be? Yes, once you are educated, once you've educated yourself, or once you're educated about how companies are valued and what the numbers are, it's actually pretty simple. But it ain't easy because we have to control our emotions and we have to basically say we have to think about what's going to happen in the future. And there are going to be times we're going to make mistakes, folks. But if we stay well diversified and stick with the big companies that have their roots deep in the economy, and the world doesn't end, that's always a very important part, we should do well over the long term. But there are no guarantees. So now, in our follow-up sessions, we will discuss some strategies about how to invest and how some people look at the world and educating ourselves. And we'll also take a look in a subsequent session in all-stars, people who are very good at it. And I always believe if you want to learn how to do something well, look at the people who are good at it and copy them. And we will be then finishing our discussions of stocks. Thank you all for your excellent effort, your excellent attention, and we'll see you in our next presentation on stock investing.